Most retail traders are chasing one thing, one big trade, one moment that changes everything. And I get it. I really do. Everyone wants out of the rat race. Everyone wants freedom. And now, not 10 years from now. But here is the uncomfortable truth. That mindset is exactly what keeps most traders stuck. The issue isn't intelligence. It's not effort. And it's not even strategy. It's psychology. Retail traders don't lose because they don't know what to trade. They lose because of how they think about trading. They are wired to look for the home run instead of building process that produces repeatable outcomes. Let's be honest, one big trade is possible, but it requires extreme patience, elite opportunity recognition, and execution under pressure. Most traders don't lack discipline. They overestimate their edge in chaotic environments. And when that big trade doesn't come, they force it. And if that big trade did come and they miss it, they start revenge trading. That's exactly what we saw last Thursday in gold and silver. The aggressive sell off caught a huge number of retail traders completely unprepared. Panic entries, late exits, emotional decisions. Earlier that same week, I wasn't predicting a crash. I wasn't calling an exact top, and I wasn't talking about timing. I was pointing out a structural imbalance in the options market. Looking at the options market, especially the February monthly expiration, I see a massive call wall at the 455 strike of GLD. That's the most actively traded ETF tracking gold prices. Those calls went in the money last Friday as the ETF closed at 458. If the writers of those calls don't want to pay out on those positions, plus there's another wall at the 440 strike, we could see the ETF price drop just enough to let those options expire out of the money. This wasn't about being right. It was about understanding incentives. When positioning becomes one-sided, price doesn't need a reason. It needs a trigger. What most retail traders ignore is that the market is constantly communicating. Not opinions, not predictions, information. The options market, especially, tells a story. Positioning, urgency, hedging, and sometimes manipulation. When traders don't understand options data, they project emotions onto price. Fear becomes support broke. Hope becomes this has to bounce. But price doesn't care about your bias. Options positioning often explains why price behaves the way it does, before retail even realizes something's changed. For traders who understood that gold and silver were extremely stretched, that a correction was not just possible but necessary, patience was the edge. And when the moment finally came, options on gold futures returned over 3,000% in a single day. Not because of luck, not because of headline, but because preparation beats urgency every time. Over the years, one lesson became very clear to me. Small wins, repeated constantly, beat one massive win almost every time. Not just financially, psychologically. They build confidence without ego. They reinforce discipline. They keep you in the game. Trading isn't about choosing indicators, it's about alignment. When options data suggests positioning and price action confirms intent, that's no prediction, that's probability. The market isn't designed to reward urgency, it rewards patience, it rewards listening, it rewards those who stop chasing freedom and start building consistency. The opportunities are always there. The real question is whether you are reacting emotionally or responding to what the market is actually telling you. If this perspective resonates with you, this channel is all about understanding markets, not gambling on them.